Picture this, you guys. Roughly 13,000 people are about to wake up not just lottery rich, but generational rich. I'm talking about the kind of wealth where your grandkids are living off a decision you made years ago just by taking a job at a rocket company. They took equity that just sat in a drawer, and now that drawer is turning into a NASDAQ ticker for the single biggest IPO in the history of the planet. Today in this explainer, we're going to break down exactly how this massive wealth event is happening, and more importantly, we're going to answer the only question that actually matters. Could you get a seat at this table too?
To really grasp the gravity of what we're looking at here, we've got to talk about the valuation they're targeting for this debut. $1.75 trillion. Yeah, trillion with a T. I want to let that sink in for a second. We throw the word trillion around a lot these days, but at this scale, the human brain just kind of glazes over.
To ground that insane number in reality, a single company, a company that builds rockets, is right now worth more than the entire economic output, the total GDP of whole countries like Australia or Spain. We are literally talking about empire-building scale here.
And the sheer scale of the capital they're raising is just equally mind-bending. SpaceX is looking to pull in roughly $75 billion in this offering. For context, the previous all-time record holder for an IPO was Saudi Aramco, the literal oil company of an entire kingdom, and they raised about $29.4 billion. So SpaceX isn't just edging past the old record, they're completely blowing it out of the water. They are more than doubling it.
But honestly, the wildest part is how fast they actually got here. In roughly 18 months, their value literally multiplied by 5. But here's the secret. Every time that valuation jumped, somebody on the inside got to sell. See, SpaceX regularly runs these internal tender offers, which are essentially buybacks where employees and early investors can cash out a slice of their shares. Because of this, there are senior engineers walking around the factory floor right now whose half-forgotten options are suddenly worth $4 million. The wealth machine has already been quietly running in the background.
Okay, so let's get into part 1, the insider wealth machine. We're going to demystify the IPO system.
So how does that machine actually work for the rest of the market? Stripped of all the fancy Wall Street jargon, here's the basic rundown of how an IPO usually works. First, the company files an S-1 disclosure, which basically opens up its books. Next, the banks go on an institutional roadshow. But step 3 is the real kicker. Historically, about 90% of the shares at the initial offering price go straight to the big institutions. The remaining 10%? Those are the table scraps left for retail investors like us. Then, on day 1 of trading, the stock typically pops, handing massive double-digit gains to those institutions before they even grab lunch. Meanwhile, the insiders are stuck in a rolling lockup period, which stops them from immediately flooding the market with shares.
And the results for those early insiders, honestly, they are absolutely staggering. Back in 2008, when SpaceX had just failed 3 launches and was practically bankrupt, Peter Thiel's Founders Fund wrote a $20 million check. Fast forward to today, that bet has seen a 62,000% return. That $20 million turned into over $19.5 billion. Insane, right?
But here's exactly why we're having this conversation today. This time around, there's a massive structural difference. SpaceX is actually reserving an unprecedented 30% of this offering, specifically for everyday retail investors with standard brokerage accounts. That is triple the usual carve-out. So the door is actually measurably cracked open for us.
Which brings us to part 2. The payload. Let's look at the actual business behind that $1.75 trillion valuation. So the door is open, but what exactly are you buying into? Like, why does this specific company command such a crazy price tag? Well, it starts with absolute, undeniable dominance. In 2025, SpaceX accounted for roughly 50% of every single orbital launch on the planet. But it actually goes even deeper than that. They deploy about 85% of all the satellites that go up. So they aren't just the market leader anymore, they basically are the market.
Now, building rockets is a notoriously hard, wildly expensive business. The real money printer here? That's Starlink, their satellite internet constellation. Starlink just doubled its subscriber base to over 10 million, and it's pulling in massive revenue. But the absolutely crucial point to understand is that their adjusted EBITDA margins are north of 60%. We're talking software company economics layered onto a hardware business. Once that network is actually up in orbit, almost every new customer is pure margin.
And they protect those juicy margins with an impenetrable moat: vertical integration. See, SpaceX is the only company on Earth that owns both the highly reliable, reusable rockets and the actual satellite network. If a competitor wants to build a rival network, they frequently have to turn around and rent rockets from SpaceX just to get it up there.
It's like forcing your competitors to buy their bricks from the exact guy they're trying to outbuild. It's brilliant.
Moving on to part 3, the blueprint. Here are the 4 real practical ways you can actually invest.
All right, so that's the empire. But if you want in, how do you actually cross the threshold? There are 4 realistic avenues to enter the room here. Route number 1 is the IPO allocation, requesting shares at the targeted $135 price through your broker. The barrier is low, but the risk supply is super thin, so you'll probably only get crumbs. Route number 2 is the open market. You just wait for it to start trading, but you risk paying a massive day 1 hype premium. Route 3 is the secondary pre-IPO market, and finally, Route 4 is buying public funds that already hold SpaceX stock. Now, while accessibility varies wildly across these, every single route comes with a stark, undeniable catch.
Take Route 3, for example. The secondary market is completely blocked by what I call the accredited investor trap. To legally buy these pre-IPO shares, the SEC literally requires you to earn over $200,000 a year or have a net worth of over $1 million. And the really frustrating part, those dollar thresholds haven't even been adjusted for inflation since 1982. It's this outdated legal wall, older than the original Macintosh computer, that essentially blocks the vast majority of regular people from these lucrative early opportunities. Which naturally pushes a lot of folks toward Route 4, public funds. The smartest backdoor entry is arguably Alphabet, Google's parent company. They actually own about 6% of SpaceX. Buying Alphabet gives you liquid, premium-free exposure to that growth. But on the totally opposite end of the spectrum, you have the Destiny Tech 100 fund, ticker DXYZ. At one point, its actual net asset value was just $20 a share, but it was trading at 60. People were literally paying triple the value just because the fund held some SpaceX. Guys, that is like handing me $60 for a $20 bill just because I drew a little rocket on it. Please don't do that.
And that leads us perfectly into part 4, the reality check. Let's talk valuations, risks, and the inevitable descent.
Look, we really need a disciplined financial reality check here, because loving a company's mission and actually making money on its stock are 2 completely different skills. Let's cool the frenzy for just a second. On a generally accepted accounting basis, the consolidated company recently posted a loss of nearly $5 billion. Yeah, billion. This was largely fueled by the massive cash burn of folding in an AI company, alongside taking on a $20 billion bridge loan. So you are looking at a wildly exciting growth story that's strapped to a wildly expensive price tag, and currently it's losing money on paper.
And it's not just me saying this. Independent analysts are waving huge warning flags. Morningstar recently ran the math and pegged SpaceX's fair value at roughly $780 billion. That is less than half of the $1.75 trillion IPO target. And honestly, history backs up this caution. Hyped mega IPOs frequently see their day 1 pops just totally fade out, and it's actually very common for them to underperform or give back significant chunks of value in their first year. So what's the actual strategy for us? Well, I am officially giving you permission to just wait. You absolutely do not have to buy on day 1. The most patient investors watch for something called the lockup expiration. Around December 2026, those insiders we talked about will finally be legally allowed to sell their massive chunks of stock. And when that flood of new shares hits the market, prices often dip, which can offer a much more level-headed, way cheaper entry point. We've seen exactly how this wealth machine operates, we've seen the incredible business fueling it, and we've talked about the brutal reality of the premium you're going to pay to get a ticket today. So, wrapping up this explainer, I want to leave you with this question. Which of the 4 doors are you going to choose? Are you going to try your luck at the IPO price, wait for the lockup expiration, take the boring but safe Alphabet route, or just sit back and watch history unfold from the couch, finally knowing exactly how the game is actually played? Let me know what you think. Until next time, stay focused and keep learning.